If you're managing your own multi-million-dollar portfolio, then this might be the most expensive 12 minutes that you'll ever spend, because I'm going to show you just how much DIY investing is costing you at your level of wealth. Most people with $5 million think that they're saving money by managing their own portfolio. After all, why pay an advisor 1% when you can just buy index funds and call it a day? And why should you trust me? Because clearly I'm an advisor, so I'm the kind of person that's going to be telling people not to do it on their own. If you don't know me, my name is Samuel Harnisch, and I'm the founder of Quantitative Financial Strategies. I have a master's in Applied Quantitative Finance, a CFA, a CFP, and spent a couple years working at a billion-dollar multifamily office. And what I've learned is that DIY investing works great until you have a certain level of wealth. Then it becomes one of the most expensive mistakes that you can make. In this video, I'm going to break down the real costs of DIY investing at the $5 million and up level. We're talking about missed opportunities that could cost you hundreds of thousands, if not millions of dollars over time. Because here's the thing, when you have $5 million, getting an extra 1 to 2% on after-tax returns isn't just nice to have. It's the difference between leaving your kids $10 million or $20 million. So the first question I would ask you is, what percent of your returns are you losing each year to taxes? The typical portfolio I review is losing anywhere between 20 to 30%. I would say on average. I've seen much worse, and I've seen some that are more efficient. But on average, you say 30% is lost to taxes. So people are making 10% returns. What they're really keeping is 7%. And that gap, that money that is lost to taxes, you can never get it back. What we do is we not only keep the returns we make. So instead of dropping the 7 after tax, we keep the 10. We also create deductions that you can take against your income outside of your portfolio or against large one-off liquidity events, like when you sell a business or when you sell real estate, or if you need to diversify concentrated stock positions. With the tax loss harvesting that we do, we can harvest over 100% of an account's value in capital losses in under 2 years. Whereas your typical tax loss harvesting strategy that you might access on your own is probably only going to get like 25% of the account's value in capital losses over that same time period. You also lose the ability to keep tax loss harvesting, and most of the strategies that people are doing on their own usually get really nice tax loss harvesting in the first year, some in the second, and then by the third year it really just trails off. With the way that we do it, you're able to consistently harvest losses in perpetuity. There isn't this drop off where the tax benefits go away. And when we invest in hedge funds, we do what's called tax aware hedge funds. And not only do those provide diversifying tax efficient return streams for our clients' portfolios, it also passes ordinary deductions, which you could take against your W-2 or 1099 income. And if you're in the highest tax brackets, a $500,000 deduction could be worth $250,000 to you. Now that's $250,000 that would have just been gone to the IRS. Now it's back in your pocket, and hopefully we can put it in the portfolio for more compounding. Lastly, we invest in real estate in a very specific way to take advantage of all the tax benefits that the asset class has to offer. We make the rental income tax-free by shielding it with depreciation, and then instead of selling properties and triggering capital gains tax, we do something called 1031 exchanges, where we exchange the property for another one where we can start depreciating all over again. Now, all these tax efficient strategies are pretty complex, and you can't do all of them at scale for yourself, or at least not well. When it comes to the tax agnostic investments, we're going to look to do those in retirement accounts, and that's where we're looking at things like private equity and private infrastructure. Depending on what time period you look at, you might see that private equity has outperformed public stocks by around 5% a year annualized. And if you look specifically at time periods where public stock valuations were as high as they are now, on a forward 5-year basis, you actually see private equity tends to outperform by closer to 9% over public stocks, because the valuations are so high in public equity markets, while you can remain valuation disciplined in private equity markets. So in addition to private equity, we also will look to do different private credit investments in people's retirement accounts. Private credit is a wonderful growing asset class. It's just unbelievably tax inefficient, because the vast majority of the return is income that is distributed to you do, that would be taxed at the highest income tax rate. So we'd pursue that in retirement accounts. And if we just look at the kinds of things we're doing in credit, we're doing litigation finance, music royalties, regulatory capital relief, government factoring. And I think one of the most compelling niche, very small part of what we do is actually lending to developers in New Zealand for attractive double-digit yields that their government is backstopping the entire program. So the range of things that you can do in the private credit space are unbelievable, and there's an opportunity to create returns that aren't necessarily perfectly correlated to what's going on in the public stock market. When it comes to the private equity infrastructure investments that we have access to and are invested in, it's a pretty remarkable lineup. I mean, the diversification you're getting globally across the board, different companies, sectors, industries, different stages of companies' life cycles, it's pretty remarkable. We own the largest data center platform in the world and the largest in Asia Pacific, the largest private cell tower platform in the world with a footprint in 25 countries. We participated in the largest take private of a US regulated utility company. We have an interest in the largest LNG export facility in the US, the largest independent renewables developer in North America. We're the largest owner and operator of boat marinas in the US, the largest port operator in North America, the largest private jet terminal operator in the world, largest toll road operator in the world, largest motorway operator in the US and Ireland, #1 global supplier of electrical insulator solutions for the grid, largest online classifieds company, the world's largest live theater operator. We're invested in companies like OpenAI, Anthropic, Jersey Mike's, Nobu, Seven Brew, AirTrunk, Rover, and much, much more. Nothing that I just said is available to you in public markets. It's not something that you can just go easily click and buy. And I'm not saying DIY investing is bad for everyone. If you enjoy managing your money and you're getting good results, then that's great. But at the 5 million level, the sophistication required to actually optimize across tax planning, financial planning, the investment portfolio, alternative investments, being well diversified, that's just something that's a full-time job that's too complex for you to be doing on the side. At QFS, we specialize in helping families with $5 million or more in investable assets create the same kinds of portfolios and tax planning that normally families with $100 million would expect. I've been hired by multiple billion-dollar family offices to come in and consult them on how to make their investment portfolios more tax efficient. So it really, really resonates with wealthy folks that understand taxes are your #1 expense over your lifetime. And if you can find ways to consistently cut that tax bill down, that's going to move the needle more so than any sort of, stock picking or investment manager that you think you found that's so great. Nothing beats tax alpha. So if you're curious about how much you might be leaving on the table with your current investment strategy, go ahead and reach out after this video. Now, let me show you the next cost that most DIY investors don't even consider, and that is the opportunity cost of your time. Time is the most precious commodity on earth because it is finite. Everyone gets 24 hours a day, whether you're the wealthiest person on earth or you're a young person just starting your career. You can always make more money, but you can't make more time. And once you reach a certain income or net worth level, each additional dollar adds less and less to your happiness and freedom. But each additional hour saved by delegating, automating, or simplifying feels disproportionately more valuable. That's why wealthy people pay for concierge services and advisors for financial and wealth planning and CPAs for all things tax. You might even hire a personal trainer because it gets you to the gym with an organized plan for something to do when you get there, or something like a personal chef just to cut out all of the time you spend cooking. Whatever it is, it's all about using your resources to get time back. They say you can't buy time. Well, everything I've just said are examples of ways that people really do buy time. You only get 24 hours in a day, and if you're spending it on any of those things I just mentioned, or what I'm talking about now, the hours that you're spending on your investment portfolios, your financial planning, tax planning, you got to take into consideration, even if you don't believe anything that I have said up until this point of the value out of the investment investment strategies we have or the tax planning, you gotta factor in what is your time worth. Because if you're very successful and wealthy, maybe your time's worth $1,000 an hour. I had one person tell me, I think he has to be exaggerating, but someone with a net worth over $100 million, he goes, I think I spend about 100 hours a year working on tax planning, finding, because he has so many different 1099s and K1s, finding all of them and getting organized so that he can file his taxes. If I had $100 million, I would outsource so much of my life so that I could have time to do the things that I want to do. That doesn't sound very fun, looking around to find your K1s and 1099. So I think that's something that genuinely, if you're not deriving happiness and utility from the DIY investing, just think about the additional time that you're going to get back if you hired someone to help with those things. And I'm obsessed with portfolio construction and tax planning, but not once has that ever been what a client has said they've appreciated or enjoyed the most about our engagement, unfortunately. It's always that they say they feel so much more peace of mind and they feel so much more organized now that they have a financial plan and they know that someone's holding their hand, walking through each sort of significant life event that occurs, that there's always someone that has an eye on things and is making sure that their situation is optimized. Maybe one day someone will say that their favorite part is the investment portfolio or the tax savings, but it hasn't happened yet. Okay, the last piece I'm going to touch on is risk. So people talk about diversification, and I think sometimes people get bored of diversification or they kind of overlook it. I have a lot of years of education through school and graduate school and the CFA program and the jobs I've had. I'm telling you, diversification is the free lunch in investing. It's the greatest possible, it's kind of like magic. So what you want to do is, instead of limiting your investment universe, you want to expand it to include all kinds of different asset classes. You've got stocks, you've got bonds, you've got real estate, you've got hedge funds, you've got infrastructure, you've got private credit, you've got private equity. If you can build a portfolio that includes all of those, you're dramatically going to increase the probability of success. You might not even change the expected return of your portfolio. If you're sitting there and you're saying, well, I expect 8% return from the stock market, I might build a portfolio that has all of those things I just mentioned. And I would say, yeah, my portfolio has the same 8% expected return. So we didn't increase the return expectation. In reality, we did, because it would be more tax efficient and there would be less volatility drag, but I'm not going to explain that. But the consistency of that would be so much higher. You can go through 10-year periods of drawdowns in public stock markets where you don't make any money. That's highly unlikely for a portfolio that is diversified across different risk drivers. So I think that's a last thing I would say on the DIY investors is it's been an unbelievable time to invest in stocks, specifically US stocks, specifically large US stocks, which are the ones that you and I think of and can name. It might not be the case that the next 10 or 20 years look like that. And it's a great time if you were fortunate enough to experience that run up, that rise, and you rode that wave in your portfolio. What a great time to diversify and really protect that wealth that you've built. So if you add up all the costs of tax inefficiencies, missed opportunities in the retirement accounts, the stuff we can do there, and your time, and if you were to compound it, we'd be talking about millions of dollars over your lifetime. The math is pretty simple. If certain strategies or structures can enhance your after-tax returns by 2% a year, that's $100,000 a year on a $5 million portfolio. And over 20 years with compounding, that's worth over $5 million. And we haven't even talked about pairing that with proper estate planning to make sure that that wealth is actually preserved as you pass it to the next generation. But that's just some of the peace of mind that you can expect when you have a comprehensive financial plan. At your level of wealth, the question isn't whether you can afford professional advice. The question is whether you can afford not to have it. If you're ready to stop leaving money on the table and see what we could do for your situation, go ahead and use the link in the description to book a call. We'll look at your current approach, identify potential opportunities for improvement, and show you exactly how we could optimize your financial situation. Thanks for watching. Subscribe for more videos on sophisticated wealth management, and I'll see you in the next one. Peace.